Hello and welcome to More Than Commas. My name is Paul Adams. I'm your host, and I'm honored today, as always, to be sharing with you and this conversation Cory Shepherd, who's one of my favorite people on the whole planet. In fact, I saw one of those memes last night that said something like, I get it, only 3 people like me, but that's just how I am, or something like that. And I was going to send it to Cory and my wife and say, well, that's 2. Does anybody know who the 3rd is? So I'm glad
that's
that you're
the only
here.
meme you haven't sent me.
That's right. Every other one. So in front of our entire audience, Cory, I'm going to break to you some what was probably good news for you. I cannot tell you how often I queue up one to send you, and I'm like, it may be a little much today, so I will not send you that one. And
that is news to me, because I was thinking like our friend who, when we asked how many push-ups he could do, he said all of them.
All of them?
I think that's how I think of, like, someone asked me, like, how many memes does Paul send you? I'm like, all of them?
I
guess not.
Norm Macdonald, before he passed, had a goal to be able to stand on stage with no act and be able to make a joke about anything, like he had built that big of an index. I personally would love to have a full relationship with somebody via text where we only communicated fully by memes. That's just a life goal. Something I could take on in retirement. Other people take up macrame, knitting, cooking. Yeah. I'm going to become a meme lord in retirement.
That's I really look forward to hearing about when you meet that person that you can have that full meme conversation with.
Indeed. Well, that's not why we're all meeting here today. We want to talk to you guys about what's going on in the market. Now, here we are in the middle of a whole bunch of volatility, both in U.S. markets and otherwise. And you might wonder, how is it Paul and Cory are able to have a light, casual conversation about memes in the midst of all this? And what you're going to see is it comes down to being super well-grounded in your investment strategy and making well-grounded assessments about what you read out in the world. So we're
not ignoring what's going on out there, and some things are happening, and it's going to be tough for some people, and it's happened before, and it'll happen again. And we want to bring you some context about what's happening and what we're thinking, both just how we feel about it right now, but why we feel that way is not our feelings, but our data and our numbers. And I think that's important. You were going to look at we haven't looked today yet because it's pretty early on the 8th.
Yeah, let's see. Let's
8th
see.
Of
what
April,
time are
2025.
8:53 a.m. on the West Coast as we speak. You guys will see it on my screen here. So here's where we stand right now, Cory. We have the S&P 500 up 2% today, Dow, NASDAQ, crude oil, gold, everything is up significantly. Now, this ended something because Sunday night, here we are Tuesday morning, Sunday night, if you were looking online, you saw all kinds of terrible news because it was the futures market said the S&P 500 would be down a full 5%, and it was super down on Monday, and now is in a bit of, I don't know what to call it, recovery's territory, but it is bouncing back up. And it doesn't point to, like, this doesn't mean the S&P 500 is done with its difficulties. It just means this is where it is right now, and it happens to be up from yesterday. And this is the part of the market that's unpredictable. A whole bunch of people were selling off for certain reasons yesterday, and now a whole bunch of people are buying for some other reason today. But we're not investing in the market for what we're going to have in 3 weeks. We're investing for what we're going to have in 3 years, 13 years, 30 years. And the strategy based upon those timelines might need to be different, but we're not investing so that we can pull the money out and get a vacation home tomorrow. So, Cory, not only are we not pulling out the money right now, we're in fact in one of many situations that have been very, very scary for investors over time. And yet what we see time and time again is these CEOs, these entrepreneurs that are leading these companies, they have problems in the marketplace. And the reason they do so well is they adapt their companies to whatever the new environment is.
They figure out a way, right?
They figure out a way. And you can see over time that entrepreneurs and heads of publicly traded companies have been dealing with worldwide tragedies and disasters, and yet the market continues to march forward. And that while every time someone says it will be different this time, everybody always only says that in the moment. Because when you look back at all of these events, all the way back to inflation in the US being 13.5% in the 80s, to us having missiles in the 1960s in Cuba just off our shores. We have the subprime mortgage crisis, all of those things mixed in, and yet the market kept marching forward, and there was no good way to get in or out of the market at the time. And now enter this article, or you were sent from Barron's.
Right. So a member of our community sent this article, which that picture that you were talking about only went to the 70s. So like the missile crisis wasn't even on there. And we're going back even further in time to the Great Depression, because every time it really rises up to this, like, no, this time is different. Like the Great Depression is one of the big standards of this is how bad things can get. And I think it is worth thinking about, like, making sure we're not getting stuck in just recency bias of just our lifetimes or our careers. Like, it is important to look way back into the past, not because it's going to be exactly the same, but because we can learn some lessons about what to expect. And so this is the article by Philip Tews.
Tews, I think is how I'm supposed to say
you
it.
had a chat with him. you were able to have a chat with him, so you know the pronunciation, but sorry if we got it wrong, Philip. Paul, maybe just because you got to check in with him, would you give folks the intro to the article and with a chat that you had with him before we dive into the meat of it?
Yeah, you bet. So, had a chance to talk to Philip earlier this week, and he shared with me a bit about how he came up with some of the assumptions. And the part that I didn't love is I said, "Hey, could you just send me the calculations and source data that you used?" And he said, "You got to get the book. It's calling the book." I have lots of people that have looked at these numbers. They're accurate. You got to get the book. And so it kind of left us in the same spot as he's saying his stuff is well grounded. And you'll see as we go through this, we were unable to duplicate what it is he said was true using the data sources we have, but we'll give you our answer.
While we're not journalists, we were trying to have some journalistic integrity and talk to him about some of the area. Like, we love a lot of parts of the article, and he is a really good writer. We really appreciate like reading the article, and there was just a few data points that we couldn't fully reproduce. Then we weren't sure why we were off with what we were coming up with versus the history he was quoting. So actually, Paul, I have an idea. I know you're the one normally comes up with the wild and crazy ideas, but if anyone listening wants to go get his book, read it, and find the research that we didn't have time to duplicate, and point it out in the comments, like, we'll get some swag to you. We'll figure something out to make it worth your time.
Indeed. I love that idea, Cory.
Yeah. All right, Paul. So where do you want to dive into the meat of this article?
So this line here, Cory, consider bonds widely regarded today as a portfolio stabilizer. Now, he's going to go on to say bonds had a bad rate of return over 36 years. From 1945 to 1981's bonds experienced a crushing bear market that saw fixed income portfolios decline by 21% in real terms over an astounding 36 years. So, of course, you first blush read that and you think, I lost 21% over 36 years. What he's saying is that there was just a slight, inflation was slightly higher than fixed income returns each year, such that over 36 years, they accumulate a little less than 1% on average each year to be 21% differential in outcome over that period of time.
And this is where it's
real terms.
This is where it's so tricky. Number one, that first line about portfolio stabilizer, which is a great context, but then the rest of the paragraph really strays from that context. It's putting a different lens on bonds than what they just said, because cash could also be a stabilizer of sorts. Like throwing cash in there as a comparison would be really useful for me if I'm thinking about the different parts of the portfolio. But like this is
Exactly right.
where,
And that's the one
yeah, go
where
ahead.
I just wanted to say is that he's saying they're a stabilizer, but then right after he's saying, but they don't have any thrust. But if I have a stabilizer on a boat, its job is to stabilize me, not drive me forward.
Right.
And it's as if he's saying, widely regarded today as a portfolio stabilizer. Then he says the next thing, and then says this reality has vanished. This is where we're going to go to Cory with some numbers. This reality has vanished from many investors' consciousness after 4 decades of bond prosperity. So those together, even though he's not saying it, what you as a consumer could be doing is reading this and saying, well, I shouldn't have any bonds in my portfolio because of how those sentences string together. And that's why we don't want to just go make financial moves because of something we've seen in an article that we haven't fully assessed with a pro like Cory.
Well, and this, as I was reading that, this is where I just get naturally curious. I'm not even like out to get someone who's writing an article when I'm reading it, out to disprove it. I just get curious about, like, is that how it really is, or how does this really? So we have a great tool from Dimensional Fund Advisors called the Matrix Book that they put out every year. And we have a printed version in our offices, but we also have a PDF that I'm going to show you. And just a warning that, like, your optometrist would be jealous of this tool in terms of how we can check your vision. So let me show you what I mean. And I'm going to even zoom out a little bit so you can see this whole thing. So this is a page of 1 month treasury bills going from 1926 to 1923. And you can't even tell what this is maybe from this scale. Looks like one of those pictures where they, print out like little computer symbols and it makes someone's face out of it when you look back. Like,
I remember doing that as a kid on MS-DOS. It'd take all day to make a smiley face.
So if I zoom in and I'll pick, so 1941 was the first year that he just referenced.
Double check the article. I believe so. Yep. He said 1945 to 1981.
Oh yeah, 45 to 81. So
and I just want to say from 1945 to 1981, bonds experienced a crushing bear market. I'm just saying that's what he said in the article.
Yeah.
We're going to look at the data, but I just want to be present to what's in the article before we look at the data.
So this is short-term government bonds. And this, in our portfolios, when we're using bonds, we're leaning towards short-term so that we actually have the most stability to let bonds do the job that we want them to do. So not all the way to short-term government bonds, but just as an example, 1945, we come down here to pick our end year, which is 1981, and we can see short-term bonds actually averaged 4% per year. And we saw barely positive, but we don't see any red here. So my first look at that was like, there's no big downturns or crushing losses. Now, long-term corporate bonds. Oh, go ahead.
Again, the language though sounds like bonds were going down. So
right.
I think he's trying to communicate what he feels like is the severity of his sentence, but unintentionally you can read that, and without deep vetting, it just feels like bonds lost 21% of their value over that period of time.
This is 1945 to 1981 in long-term corporate bonds, and that's 2.6. So worse. And the other thing that I noticed is we can see 55, some single year in the 50s and 60s, some single year and multi-year periods where they were negative. So we definitely saw that happen, but it just wasn't this crushing long-term downslide that I was expecting. And then I read that in real terms. That little 2-word part of the sentence changes everything when I then went to the Matrix book, looked at, inflation was about 4% over that long-term period, as long as, CPI, at least. We could talk about inflation in different ways. But then it made sense to me that, I see what he's saying. It just didn't quite keep up with inflation during that period of time. But but that's not what we were wanting bonds to do. So he's accurate in the total set of assumptions he's making to frame that sentence, but then we would go in a totally different direction with how we would implement bonds in the first place.
Now, as we move on from that section, go down here, stock investors face similar historical warnings. Now, again, it's very easy when we hear that to go, it could be the same thing. And then it follows with 67% plummet over 13 years. Now, what is left out of this, just for context? We had very different monetary policy back then. We had a different ability to access international markets, or for people to actually hold a diversified portfolio back then. So many people we didn't have the democratization of mutual funds and ETFs the same way back then. To appreciate the psychological devastation of such a scenario. Recall how you felt during the March 2009 financial crisis. 30% decline in balanced portfolios seemed unbearable, yet mercifully ended after 16 months with a powerful recovery.
Now, I do agree that exercise of taking yourself back, remembering how you felt living through that, is useful to practice our kind of emotional responses, and even talks about that more at the end of his article. So I love that as a practice.
Yep. And the other reason that's important is going back, putting yourself through those periods with the money you have now. Because each time you get through, like when you rebalance and you get through this market cycle, you'll have more money than you had at the beginning of the last one, which means each downturn feels scarier. The more disciplined investor you are, the more the next downturn can get your attention, because dollar-wise, it seems bigger to you, even if the percentage was less. And then he says, compare that with Great Depression experience. After similar initial declines, stocks fell another 43% in 1931 and 43% in early 1932. A balanced portfolio lost 67% of its value, or 72% for investors taking a modest distribution. Now, again, we don't have the math behind how this was done, but I'll give you guys.
But I do have some tools to kind of get close to it.
Yep. And I'm going to give you guys the worst tool to use first before we look at Cory's. You could check this right in ChatGPT. So Cory has some great data for us, but I'm just going to show you the kind of thing you can do to do a quick double check of somebody like that. As I just added, what if I had Dow Jones Industrial Average with 20% fixed income? And you can see the Dow Jones Industrial Average after the Great Depression in the red line, according to ChatGPT. And then according to ChatGPT would be the orange line, which is just a very different outcome. This episode of More Than Commas is brought to you by Sound Financial Group, where we help families and business owners build and protect wealth through clear, long-term financial strategies. Whether it's retirement planning, investment management, or navigating your overall financial strategy, we're here to help guide you every step of the way. To learn more about how we can help you secure your financial future, visit sfgway.com. You can run retirement calculations and download content to read in your own time. So if somebody's going back to the past and they are showing the performance of any particular index and then trying to draw a conclusion from it, you might want to do a simple check to say, wait, that's different than a diversified portfolio, which is what I have. So they're using indexes to point to say why the diversified portfolio wouldn't work, when in fact it would be rebalancing regular.
So I got curious again, and I tried to figure out how we could do some kind of back testing, because going all the way back to 1926 is tricky. None of the ETFs that we use now were around then, but the asset classes were. So if we can find some indexes that go all the way back to that period, then we can kind of simulate our portfolios back that far to get a general sense of the movement. So Dimensional Fund Advisors gives us another tool called ReturnsWeb, where we can research some different indices going back a really long time. So this one has a bunch of different indexes, and it starts in 1926, which I just wanted to show you to give you a sense of all the component parts that I put together. And then we're going to look at that specific 14-year break even from 1937. But you can see Eugene Fama and Ken French created some Nobel Prize winning laureates here, created these different research indexes to look at how we think about different segments of stocks now, back to 1926, where they didn't think about anything but we got a bunch of these big companies. They didn't separate small cap. Like that was many years before anyone started thinking about stocks in a large versus small kind of categorization. So we have all these indexes of US large and small and value and growth. And so I built a Great Depression diversified index portfolio that tries to approximate the tilts towards small and value that we would use in a portfolio today. It's only US stocks because we didn't have good data on international stocks until the 1970s.
70s.
So
Yep.
it doesn't do everything for us, but it gives us a sense. So here is that 1937 to 1951 range where the article talks about the S&P not recovering, or the S&P's predecessor. It's still not exactly clear what that is tracking. From 1937 on, didn't recover for 14 years. Well,
And I did get one point of clarity from Philip on that. So
perfect.
So even that wasn't the end. After several years of recovery, another 5-year bear market emerged in 1937, pushing balanced portfolios down another 30. What he meant that to be was that from 29, 14 years going forward, he did understand that. So if you go to your 1929 one.
Well, so 1929, I have 10 years. Yep. I have 13 years. I have 16 years. So
they all look pretty positive. They all look
pretty positive. See, this is where we thought that, because we looked up just the S&P point-to-point movement without any of the dividends, and that looked similar to what he was saying. Now, he said that's not the case, that they would have had dividends in. So that's one point where we cannot reproduce what he created. We'll have to, take some time to figure out where that went. But I just know what we can find is Dimensional's ReturnsWeb is showing something slightly different. And when we look at our Great Depression diversified index, 1 year was down, 3, 5, 10, 13, 16 are all positive.
And it could have been that year 7 was negative and year 8 was negative.
Right.
And that's why, if for those of you that are like, oh my gosh, in this environment, I'm going to be taking retirement income soon, go back and search for our episode on the volatility buffer. Marla will find that, and she'll put the episode number up on the screen and maybe link it in the show notes below. But what I want you guys to be able to do is go back, look at that, because as long as you have an appropriate volatility buffer set up, just because you're retired doesn't mean you became a short-term investor. Oh, that kind of gives us a little taste of it.
This gives us a little more sense. It's packed because there's so many indexes on here. But you can see that we went negative for a few years and then back up, negative for a few years, back up. But it just wasn't 14 years to come completely back to even.
And if
this
those
one's
were
a
all
little bit
rebalancing against one another.
Right. This one's a little bit easier to see in that 1937 timeline that we did have a nice long stretch here of years where we were down.
Yep.
And then the recovery was pretty incredible.
Yep. And here's things that we didn't have back then that we have today. For instance, his study used a 1.6% asset management. He did share that with me, which is higher than what most people would pay today, but might be accurate for what they paid then. But if it's accurate for what people were paying back then, but you're comparing it to markets today, it would seem like it would make sense to use markets today to test it. And what this article comes down to, and many other ones come down to, is what's the aim of the author? And I enjoyed my conversation with Philip. He was very gracious, taking the time with me, etc. But the same way we are doing this podcast to keep our clients educated, we hope many of you out there beyond our clients are enjoying this. But our goal is to keep our clients from making poor decisions in between meetings. And not poor decisions because they're poor decision makers, but poor decisions because if you get in a deep milieu where it seems like everybody is, say, day trading and making money, it just feels like I should be day trading and making money. And then volatility happens. And that's what we're seeing happen in the market now. So when Mr. Tews says, hey, what you'd need to have, which is the later conclusion of the article, we'll link it in the description below. But where he gets to is you need to have active management, you need to have hedging, you need to have some of these things as a part of your portfolio strategy. And his assertion is in the kind of market we have today, that's when you need active management. But what we would say is active management proves itself over and over again to not outperform the market. In fact, over about every 20-year period that's been studied, I don't think we even have had it break 18% of them outperform the very index the asset manager said I want to be compared to. And they still can't outperform it 80% of the time. So even if Mr. Tews is right, which we don't have any evidence that active management works. And by the way, after our last one on active management that you did, Cory, I started getting LinkedIn messages from active managers saying, you guys are missing the pictures. This is why active management can outperform.
I remember that. Right.
And so I've been writing all those people back and saying,
but you haven't gotten
papers.
Right. That's what I was remembering. You haven't gotten any data back from any of them.
I've told them every single time I'll put anybody on our podcast that you want me to, if you supply me one well-researched paper that sets up to academic standards that says active management can consistently or predictably outperform the market. And here I wait, having not gotten any yet. So for those of you out there that are big active management fans, send it. info@sfgway.com, the Sound Financial Group way.com. Send it our way. We would love to take a look at it, and we'd love to have you on the podcast if you're the one that can prove that active management works. We continue to assess it. We continue to not see those results. So now is not the time to jump in and out of the market. Now is not the time to try to guess where the market's going to be in 6 months, 1 year. The better aim is to guess where it's going to be in 5 years, higher, in 10 years, higher, in 15 years, higher. And if 20 years from now, the general the general assembly of worldwide stocks don't climb over 20 years, then we as a society have issues that we cannot comprehend right now. And it won't matter how you invested if that happened. And so we just want to be an encouragement to everybody that if you've got a strategy that you don't understand, because that's one of the problems with these other strategies. If it doesn't perform well, what do? Call the asset manager and say, why did it not perform well? They said, well, we made some bad guesses. What we want to be able to tell our clients is the reason the portfolio is doing what it's doing, because here's what each asset class is doing, and we're capturing the returns, whatever they are, rebalancing consistently, and then helping our clients arrange their personal financial affairs so that they can stay with their equity investments for the relevant horizon of time to be rewarded. Because if we don't have our finances arranged in a way that allows us to be there for the long term to get the rewards, then frankly, this time is going to be a lot like other times. We're just in a place of one of the biggest transfers of wealth every time we have one of these markets. Money gets moved from the disciplined investors to the non-disciplined investors. Sorry.
Other way around. Yeah, I was
Other
like,
way around.
wait a second. I have to disagree with you on that.
To the disciplined investor. But the reason that happens is simply because we know that long-term, holding a portfolio, those strategies are not falling apart suddenly. All of the academic data we have from US markets and markets beyond and before that, like the tulip bubble, we can see that those people that attempt to speculate and trade ahead 80% of the time don't do it. And we can't predict who the 20% are ahead of time. So it's all steam ahead on being academically allocated, globally diversified, consistently rebalanced with a balance sheet that enables your way of life and your goals. Cory, anything you want to leave everybody with today?
And just be real curious and open when you're reading. And that curiosity is a great place to be, to just assess if what you're reading is helpful to you or not.
All right, everyone. Don't forget to like, subscribe, comment below, share it with a friend, and don't forget to join us next week. We're going to talk about something else very interesting, timely, and something that's going to help you get back to living a great life.